Boom. We are alive, ladies and gentlemen. Thank you for joining us today. Steel and the Arcane Bear. It's been a few days since we dropped back in for a chat. We're going to be going over Bitcoin. We're going to take a look at S&P 500. We're going to go over a few of the private Bear members' questions. And we're going to take a look at the broad market. So that's going to come from some of the questions. We'll do that at the end. But also, we're just going to kind of take a dive and look at overall sentiments right now, because I think it's important to do. So first, what we're going to do is just aim straight at Bitcoin. Bam. On the daily chart now, as you can tell, if you've been following this channel, I believe we are in an accumulation range, which is actually awesome. It means something pretty fantastic. If you go back and look at Bitcoin's previous data, up to when we got to today, from when it started, what you will find is that there are these shorter periods of accumulation within the bull market cycle that were somewhere between, let's say, 300 to 600 days. Now, the 2017 to 2020 bull market patience period, or waiting, or better yet, instead of calling it a bear market, I like to call them accumulation markets, took around 2 years. Now, because those extended time frames can become boring and drag the investor through the ups and downs of Bitcoin going from 3,000 to 13,000, back down to 3,000, back up to 60,000, the entire point of all of this price movement is basically to get rid of the weak hands. That way the supply that there is available gets locked up by people that have long-term 5 to 20-year time horizons within their investment spectrum. Now, because Bitcoin is a new asset, it falling under that category of people interested in it in the next 5, 10 to 20 years is actually relatively new. This is for a few reasons. Mainly, when technology becomes adopted, it's not adopted super quickly. So what you end up finding is that as the technology becomes adopted, we can become more and more confident about its weight into the future, right? For instance, DVDs were very quickly replaced by online streaming. So making an investment in the online disc space probably wasn't a great idea. So if we know that technology can be replaced so quickly, investing in technology that we know has shelf life is kind of one of the main aims and goals. Bitcoin's shelf life here is partially due to that repeated past and history of successive moves upwards. And this is due to limited supply and now increasing demand. I think we are basically witnessing the floor of Bitcoin's price, and there's a few reasons we've gone over to look at that. We can highlight some of those now. If we go out to the 3-day chart, we're going to take a look. This is not the entirety of Bitcoin's chart. Actually, let's use a different one here. Yeah, let's give us a bit more time. Yeah, okay. So here, what we're going to do right now is we're going to look at the oversold areas of the RSI. So I'm going to draw a line on the left-hand side of the screen here, and this represents the lowest RSI and the lowest price point at that time. Now, just before the start of this market cycle, Bitcoin around 20 grand, there's the low of RSI. Now, what's interesting here is we're actually bottoming out in the RSI. Now, this can happen a few times. If you look back from the bull market all the way down to the bottom of the oversold index, it actually took us the entirety from the top to come down and swing into the oversold area. So part of the question here is, do we swing down, bounce around 34,000, 30,000, hit a quick jolt down to 20, and then back up to 30? And that's kind of what I'm suspecting. When we look at other variations of these trading ranges, which there are many of, we're going to use one of the Arcane Bear's educational examples to explain this now. So trading ranges form through, again, this relationship of price volatility and weak hands being removed, right? A lot of big investors don't actually take profits. They just aim to hold the asset for as long as possible because they know that if they have a good asset in their hands, it's going to bode in their favor to just hold on to it. And anytime they can, effectively acquire more. And these usually big players like institutions can do this because they are generating large sums of cash flow or revenue to use in as their investment thesis. Now, over the years, this has grown and changed into a bunch of different variations of how people invest. But ultimately, some of the most strategic and powerful data that we have comes from the use of this long-term investment spectrum, because price can be very deceiving. If you're trying to look at fundamentals, you can take Amazon, the S&P 500, almost any relevant asset today, and what you'll recognize is that price and that volatility was always a good time to be buying. So when we have these stark moments and contrasts of fear, they are usually a good time to be buying. This idea of blood in the streets is actually a literal saying. It is not like, oh, the candles are red. When there are literally people dying, whether it's from a pandemic or a supposed war, these are peak moments of fear, and they are almost always taken advantage of in the opportune moment of those who make the investments, knowing that when that fear dissipates, and it will, the price will continue. Now, the start of World War III or Russia and Ukraine, I actually think it's largely irrelevant. It's more, look, we have to remember that politics is also theater. So although people die from things all the time, right? We can't negate that people are dying all the time from any number of things. So whether it's like this person specifically doing it or a knock-on effect of government policies and mandates that then do the same thing, we don't always shine a light on it quite the same, right? So for instance, suicides have been jacked through the roof the last 2 years, and we very rarely look at that. This is still people dying, and of course they're taking their own life, but nonetheless, understanding that those peak moments of fear are actually our investor's best friend. And if you go back and look at the videos that we were making in May, June of 2020, we talked about this sentiment, this idea that what you end up looking at in price volatility is largely related to humans' thought process. So these trading ranges, we're going to look at this one specifically, reaccumulation schematic 2, is one of the reasons why we've talked about the likelihood of being in an intermediary bull market accumulation cycle. And what we have done in the past is we've used the S&P 500 as kind of a visual example. So the reason why the S&P 500 is a unique example is because it's related to governments doing what they've done for a long, long time, which is printed a ton of money and backed and bolstered policies that really capitalized on that relationship between corporations and governments. Bitcoin isn't a hedge against inflation. It's actually a net beneficiary of inflation because the price goes up. Right now, what we have on the screen is the S&P 500. Now, one of the reasons why this is a valid interpretation is understanding that time is not an unimportant feature within market dynamics, right? So if I removed the bottom of the time frame, these are called, probably my favorite terminology fits under this idea of scale invariance, that in mathematics, when we look at mountain peaks or we look at the breakdown of how sand moves, it's all the same regardless of the scale. So when we change time frames, we are ignoring the scale of the time frame because it is almost unimportant. What we're looking at here is functional structure. And the S&P 500's bottoms of 2001 and 2008 effectively were financial stock market collapses, apparently, right? But when we compare them to what an accumulation cycle looks like, it actually becomes the same thing. Now, the S&P 500 was very strong out of its breakout here too, but again, what you have is another scale invariant function of a trading range. Here you have another trading range that took place between August 2014 and 2016, and I remember that this is where I really started to change my thesis on what the markets would do. Now, I was a fan of Peter Schiff back in those days, although I was buying Bitcoin, I was also interested in gold and the conversation around inflation. And I think largely it's a bunch of noise that gets in the way of understanding sentiments properly. Because we know that when people are scared, we want more assets because the governments are fundamentally doing the same thing around the world. They are increasing the monetary supply, which looks like inflation. Again, that decreases the confidence and the faith in the fact that that government and that, I guess, culture has the ability to repay their national debt and the effective cycle that goes along with how much they produce. So the S&P 500 is a really good example of that because it's a basket of a bunch of the top performing assets for the last, we're just looking at like 40 years basically around my lifespan. So within my lifespan, we've seen again, is unique here is that you have this big run up that forms two accumulations, and that could be very easily viewed as a double top, which is what we are seeing in Bitcoin right now. Now, again, you have to ignore the time frame because the time frame is irrelevant. Time is not a function of price. They're not related to each other. What time allows is for events to happen. And as we get into new areas of time, why would we suspect that those events would have the same apparent frequency? Right? We can't make bets off, hey, every 7 years the stock market goes down, right? I remember actually there was like a Jeff Berwick video. They were talking about this Jewish debt cycle. I forget what it was called. But anyways, in 2006, when a lot of people were worried about the stock market, I went bullish. And the reason I went bullish, and I make this comparison frequently, is because I started to understand the reason why I was invested in Bitcoin wasn't because of an inflationary hedge. Again, it is the net beneficiary of inflation, because as they create more dollars, where are those dollars going to go? Those dollars are inherently going to go to assets, at least if those dollars are in the hands of smart investors. So when we look at this orange line, which now is actually, let's do both as lines instead, it'll be a little clearer. So the white line is the S&P 500. And the orange line is the monetary, the M2 supply. So we're currently running, there we go. So this is from 1998 to today. And what you can see is the price fluctuation moving through the range is noticeably volatile, yet the increase of the monetary supply stayed quite consistent. So we can then assume that because the monetary supply has been growing consistently, this is largely what inflation comes from. It's more of a symptom instead of money doesn't create inflation. More money then has side effects like inflation, or actually a bunch of other side effects that usually take place here. But as we move through the cycle, the volatility comes from human nature. That and some of the companies that were totally crap, which is fair, right? Some of the companies didn't deserve to have an evaluation as high as they did, especially in the early .com. And in 2008, in the crisis and collapse, we just bought all the companies out that didn't deserve to exist. Like all the banks that basically can shit themselves in their relationship with Freddie Mac and Fannie Mae or whatever, that circle jerk of nonsense that these regulators had created with the banks. What we saw then was the fear take over, and again, the companies that should have been destroyed were basically bought out. So both times, these were instigated by the nature of human fear. And then in 2008, they capitulated by saying quantitative easing, we're going to buy everything. And in 2016, when a lot of people were really bearish on the market, I went bullish. Now, you can look at the trading range here that took place. And this trading range, again, has some really unique dynamics to it. Again, scale and variance means that as we zoom in closer, the way we kind of look at each of these trading ranges will be different. But fundamentally, we're looking at an accumulation range. We saw a hard line to the top, slam back down to the bottom, hard line to the top, slam back down to the bottom. Now, this would be your PSY. This would be kind of the first start of the market. So again, we have this kind of very sharp, definitive up, down, up, and then away it went. So actually quite similar. So these accumulation cycles do not need time frames. You know, there are some people that are commenting on Twitter being like, oh, well, the time frame is so... Look, there's a reason why the reaccumulation schematics at the bottom here don't have a time frame. Is because it is irrelevant. It is much more reliable on the larger time frames. This is for sure. So where am I going with this? Ultimately, I believe we are in the middle of an accumulation cycle. I don't think the fear of this so-called war is going to do basically anything. I think it's a flash in the pan. Now, again, we could get into some semantics around, oh, you don't care about people dying. So people die all the time. How are you asking me to care about why they are dying? That's more of a physiological question. It's not an investment question. The investment question says the same damn thing. When the news is full of noise around war and blood in the streets, those are largely the best times to accumulate. It was the hardest part to really get over in May 2020 when I'm like, okay, so to be a really good investor, you have to actually adopt this kind of sociopathic thinking, which is when everybody else's life might be disrupted, that's the best time to be investing. When everybody else's life is being disrupted, I should be doing my job effectively. That's the nature of this game. Human fear instigates downside. Downside is accumulated by those who have a decent chunk of capital sitting around and can think in 5 to 10 year time horizons. And then the market continues upwards because governments have done the same thing. They destroy currencies on behalf of the people who want free shit. Anyways, so largely, I believe we're going to see something very similar with Bitcoin here. We still could come down, let's say, to the $24,000 to $20,000 mark on a spring, where you would see something like this, bang, bang, before continuing up higher. It's unlikely that that's the case. So let's just very quickly, before we go into kind of some broader market overviews, let's just take a look at some data here on Glassnode. First off, right out the gate, our reserve to risk relationship right now is down in green as well. So what's nice here is understanding the risk to reward relationship in any purchasing moment. So when we're sharing our screen here and we see that the RSI over the 3-day is actually hitting quite low. Again, it could go lower. We could see a depth of a spring here, and a war would be a perfect time for that. So it would perfectly kind of fit our time frame for what would come next in the accumulation cycle. Again, remembering that phase C, a spring, we can look at a few different variations of these accumulations. Like this would be a great example. Although it has a different type of peak, phase C would actually spring down below, which for where we are now would probably be the 314-day moving average-ish, around $24,000 to $20,000, whereas this nice big gap up here. So ultimately, although we could come lower, it's not much lower. And if there is more fear, it's strictly time to be buying. So this is why we always suggest a month-over-month strategy instead of just a lump sum investment ideal. Throughout time, you can perfect your strategy the same way you would by going to the gym or learning an instrument. The technical repetition of these mantras creates the success. Now, can it happen by accident and randomly? Of course, yes. I highly suggest reading books like Fooled by Randomness. The Power Law is another really good book. And there's another great article by MIT that says, oh, if you're so smart, why aren't you rich? It's like, and then it says, well, that's mostly because of chance. And Fooled by Randomness is a fantastic book by Nassim Taleb, who shares that. Now, Nassim's gone off the deep end. I'm not a huge fan of his Twitter account, but his books are great. His short-term thinking is all messed up right now, so we won't even go there. But his long-term philosophical thinking fits perfectly. So I basically ignore Nassim Taleb on Twitter and just only read his books, because his Twitter is just trash. Anyways, Nassim, I love your books, but I hate your Twitter. I guess long-form content for some people only. Okay, so this is going to bring us into the next part of the show, where we are going to look at questions from the private Bear Den members. So if you happen to be in the private Discord channel, we're going to do it from this way now. On this way, we can vet conversations before just looking at whatever the YouTube channel is saying. So we're going to go with that as well. Just as a heads up. So here we go. We'll scroll to the top. Let's take a look. From Kevin Casing here, he says, would love an update on the gaming side of things, and I will how we'll be stepping into that. Also, Avalanche. Okay, perfect. Avalanche we already have open here. We'll start with this. This actually gives us the opportunity to share another kind of like in-depth, or we'll go less in depth on the thought, and we'll focus more on the technicals here. But ultimately, we are really big fans of Avalanche. We're looking at Avalanche on the daily. The previous best time to buy Avalanche was down when the RSI was around 27, effectively, right? We've already peaked out, and we've come back down and hit that 27 mark. Now, could we come lower? Yes. There's a nice big gap here around $54 between the previous all-time high. I think Avalanche is an extraordinarily undervalued asset right next to Solana. I think Avalanche is actually probably more undervalued than Solana on technical terms alone, but that's a different story. Not super technically savvy, so we don't want to trust me totally and be like, hey, I don't want to talk about technical. Like, I know if my mouse didn't work, I'd be fucked. I'd have no mouse. I hate fixing things. Not like that, at least. Okay. So because of this, these lower RSI forms, peak moments of fear, these are great buy areas. Technically, again, we should almost be minimizing the price chart and focusing more largely on the fundamental thesis here, which is that as people get scared, so what will give us moments of peak fear? RSI at a bottom is a great way to do that. And as we increase the time frame, we also increase the likelihood that we're getting it right. So if you look at Avalanche, not even enough time frame on here for Avalanche, but we're in a neutral area of buying. So when we go to the fundamentals, and we'll use Bitcoin here to kind of side this on, and our basically our relative risk is right back down at the bottom. It alludes to me, again, the idea that we actually have this thesis right, that the reaccumulation schematic that we're seeing for Bitcoin and that we're going to see for all these assets is exactly what it is. It is a mid-range accumulation cycle, and it's a very powerful one because we did not have a mid-range accumulation cycle for Bitcoin aside from the $3,000 to like $4,000 mark before it went to 20 grand. So this is very likely the last time you are going to see Bitcoin within this range. And then when it marches out from here, it's just going to keep marching onwards and upwards because the people that now hold this asset have a lot of fucking money. Okay. And that's the important part to remember. The reason why Bitcoin was so volatile before is that many of the people that own Bitcoin, crazy people like me who bought it at $200 and shit, we spent a bunch of it. I'm like, cool, I'm going to spend it here. I'm going to do it there. I'm going to try to build a business. So I failed a business there. I lost a bunch of the money. And ultimately, the goal of investing is to never spend the assets. And this is one of the things I really learned starkly too, is that assets are not really for day-to-day what you need. If you want to build a portfolio, it's going to take you some time. And that may not necessarily feel like it aligns with the vision of you needing more money today, but it also aligns with the vision of, well, how do you get fit? It's not just like, I'm fat fuck today, I'm going to go and be super ripped tomorrow. You can't do that. You need a repeatable process, just like anything, even with health. Is what do I do on a daily basis? How am I standing? I've recently had like a little bit of a back problem from my bed, and I'm like trying to fix it by doing the opposing things that I've been doing, which is what do you do too much of? I spend too much time with my shoulders forward. So reversing these processes actually take a significant chunk of time. So if you want to increase your wealth, or basically go from no money to a lot of money, you need to be repeating the process like you would a good mantra. And that effectively is how you become successful, no matter what your quality of intellect or emotional intellect is. You can repeat this process no matter who you are, and it will be successful. The things you can get wrong are getting the investments wrong, which is why we focus on Bitcoin and things like Avalanche. Now, which takes us to the gaming sector. So gaming and Avalanche are much closer to what we call venture capital. And they're important to recognize, just like one of the reasons we love Bitcoin, is that the upside potential is so dramatic that if you still only have to wait a year or two, if you can turn 10 grand into $1 million in 2 years, you've done very well as an investor. There are countless books that go over this type of idea. Again, 100 Baggers, absolutely amazing. It's important to understand that what you want to function in your favor is asymmetric behavior. And often that asymmetry is hard to manage, so you sell too early. And one of the best things you can do is not generally sell and focus on just buying more, because the upside, if you are right, and something like Avalanche is so high that when we were first looking at Avalanche, it was at 35 cents in its private sale, right? Because we talked about Avalanche before it launched. Then it bumped around $1 to $3 for October, November, December, January, February. Okay, so about 7 months. For 7 months, you could buy Avalanche between $1 and $3. So let's go back and look at this. What does this feel like? And here, this is why scale and variance is such a fun function, is that we can look, and I'm going to actually have to bring it back down to the 1 day to get any usable data here. So there's the accumulation range of May to June, but here's the accumulation range between that $1 to $3 area. Okay, bang, look at this. Look at this beautiful accumulation range. Now, this is the hard part, right? Everybody thinks, oh, I'm going to invest the 5 grand and get it right here. But what you want to do is make an investment into Avalanche and then start to understand it. And then as you understand more and more what it is, why you would want to invest in it, you can increase those investments or decrease them based off what you're learning. So you don't make just a big investment at once, because you can't learn that quickly either. You should take time to build conviction into any good investment. Let's say, this is just a smart thing to do in general. Like as the company that I'm investing in looks like it's going to be more and more successful, I want to keep doing that, right? So that's what it became. There's this big jump up to $50 or $60, and then a drop all the way back down to $13. And then for another few months, it gave you the opportunity to just buy. So let's just use it as a rough, easy mathematical example. You were able to buy from May to August. So not a huge amount of time, is 3 months. Let's say you're doing $1,000 a month at 3 months. You managed to get $3,000 worth of Avalanche over the course of 3 months, right? It's not a small investment, it's not a big investment, but it's also not a small investment. Like there's a lot of people around the world that can't afford an extra $1,000 a month. Like the majority of the world probably makes $9,000 a year, right? That's probably like where most of the billions of people are at on the planet. So remember, like it's actually probably high too, depending on who you're comparing with. So you had approximately 3 months to accumulate the asset. You bought $3,000 worth of that asset. Let's just put it in the mid-range too, around the point of control at $16. So what we're going to do here is let's do a mathematical share of from there to here today. So we go 3,000 divided by 16. We bought 187 Avalanche. So at 187 Avalanche time, 187 Avalanche times I'll put the calendar on the screen here actually, so you guys can see it too. It's not letting me. Okay. Times the $77 we're at today, you're now at $14,399, right? And that's only within like a 9-month period. So most people think to themselves, especially if you only had $3,000 to begin with, and then just 2 months later it's worth 15 grand. And actually at its high, it was worth more. At its high, you have 100. Let's go over to the high price of Avalanche. So I'm trying to just deepen the thesis of understanding of why we kind of keep repeating this. At $140, at 180, it would have been worth $26,000. So your $3,000 would have turned into 26 grand effectively, right? Had you stayed consistent with the investment thesis at around $1,000 a month into just Avalanche. Again, Avalanche is more like venture capital. The volatility is the upside, but we also know that something like Avalanche could totally fail, just like Ethereum still could totally be nothing but a CryptoPunk NFT chain in the future. We don't know yet. I didn't know that the DVD would not exist, but it's also only like 15. So what the fuck did I know then anyways? Better question yet, what do I know now? It's a great thing to ask. So I don't know where Avalanche is going to be, if it's going to be ultimately successful, but I think it is. So we keep making an investment, and at $3 grand over 3 months turned into $26,000. Understanding the repeatability of this process is to ignore the time frame, really dig into fundamentals of what can I do as an investor to increase my chances of success, and then repeat that process over and over again. Now, again, as you get bigger and you become a better investor, there are more opportunities to invest like super early. And a lot of that has to do with work. Like as we invest more, I start to realize that largely more than just investment, I want to be working with some of these companies. I want to get my hands on, get down there and see how we can help them be successful. That's what it feels like the most fun is too. So Avalanche, I believe we're near a nice bottom. Again, if we look at the RSI, both for Bitcoin and for Avalanche, we're actually coming down to a low. Could we come back down to $48? Yeah, of course. And people will be like, oh, well, why would you want to buy in? That's 50% lower. Like if you bought today, it goes down another 50%. Well, ultimately, yes, this is the point of making a good investment thesis, is that if you think that way, chances are you're going to underperform the person who just buys every 6th of the month for the next 5 years into things that they find interesting. Okay, so this sidelines us into the gaming thesis, which is our favorite. Now, for those of you in the private group, you will know that I've decided to dive into gaming. It's like a core part of my thesis now for a few reasons. A, it's less contentious than talking about like Ethereum and Avalanche or Solana. But ultimately the upside I think is very, very high. So let's take Star Atlas. Yeah, Star Atlas is a great example. I'm a big fan of Star Atlas. Now we are down significantly, 82% since its high. That's a huge downside. So I made a mistake here for sure. First off, I made a mistake by looking at thinking that this was bullish here, but there just wasn't enough time. So even though time is unimportant when you have like, let's say, closer to a decade of data, when you're dealing with early venture capital, time is super important. Usually investments like this, especially if you're looking at early investors, like let's say Animoca Brands is investing alongside some of the biggest investors. We know that the goal is to maintain liquidity while the company grows. So hopefully that company can grow to a place where it's ultimately functioning. So a good investor isn't trying to dump their tokens right away. Like Animoca's not like, oh, we're just trying to get rid of our fucking tokens. No, they're not trying to push the price down. So ultimately, when we see this in Star Atlas, we're seeing two things. A, probably a bunch of early investors who are not as classy as Animoca that are pushing the price down by selling. Maybe they need it for business operations, and also Star Atlas doing the same thing. They need capital for their business operations, not just from their fundraise. Making a video game is fucking expensive. I believe it costs like $280 million to fucking make Grand Theft Auto. So it's not cheap to make a good game, just in case you were wondering. So in early venture capital, distribution can happen very quickly, right? So we've seen an 80% recoil in price in Star Atlas, and I was actually quite bullish around this 15-cent mark. That was my mistake because it's early for venture capital, and these price swings can seem dramatic. But what happens if Star Atlas is at $1.50 2 years down the road, right? Now it's at 3 cents. That 20-cent mark is obviously not as nice as that 3-cent mark. It's like a horrible investment to have made to go in at the top, and then unless you maintain confidence. I think Star Atlas is really well positioned. They're not for the video game part, but you have to remember there's two different kind of technology bridges meeting right now. It's the video game world, which is one thing, and the DeFi world, and the building of these governance structures, and how do you maintain, and what are the more far out visionary aspects of actually using crypto in the game. Now, a lot of the games we've seen lately lean into more of the, hey, like, this is an awesome game. Well, that's great, but still, the things that are going to really kick for an investment are going to come from the abstraction inside of the way that the game and the DeFi aspect of the game participate with one another. So if it's early to an investment, if it's something new, like a Solus, like another metaverse investment we've made, or a Decimated, another investment we've made, it's too early to tell. So one of the things that the patience also does really well for is it starts to get rid of getting it wrong. That way you're limiting how much you're buying on any given month, and you're allowing time to work in your favor by now the price is 80% lower. So instead of making any single buy, and again, this is why why I repeat this, is because that's not how the average new investor thinks. And we're trying to help you cure that, because I was once the average new investor and I made every mistake under the book. This is a simple, easily repeatable process that you can repeat as long as you understand what venture capital is. Bitcoin basically went public this year, so it's not like venture capital as much anymore. It's more like a public company. It's got some serious time and energy on deck. Star Atlas is definitely like is definitely like venture capital. And just for fun and shits and giggles here, let's bash on Moderna. This piece of shit here has also fallen. Let's see. 72% since its high in August. So this is also like apparently venture capital. Not enough time in this company for me to in any way trust any fucking product that they make. Bitcoin's older than this garbage. I wouldn't trust anything with this short of a time frame. Anyways, I suspect that Moderna will probably come down quite a bit lower. We could probably see it low as $30, $20. I would suspect it's coming all the way back down to its bottom. I would suspect you'll see a full retracement. And again, when we look at our venture capital thesis, you have to understand that volatility is actually our friend. It only doesn't seem like our friend when it's going down, right? So the asymmetric volatility is what we're looking for now. And that's okay. As an example, right, for Star Atlas to get back to its high, it's got to go up 500%. A 5x. Most investment funds would love to get a 5x, but they don't. But in venture capital, a 5x is boring. You're looking for a 1,000x over the course of 10 years, 5 or 10 years. And that's what we saw with Axie. We saw Axie, this video game, and I was not at all aware of how well these would do until I started to dig a little deeper. So Axie has also gone down significantly. If you bought at the high, you're dealing with an 80% retracement, right? You think, oh no, this is just horrible, 80% down. But when we look at where we were in April, of 2021, approximately $7, you had a 23x return in less than 200 days. That's phenomenal. It's unparalleled, basically. Wait, hold on. It's actually even higher than that, isn't it? No, it's 23x. It's a phenomenal return. And if you had gone back just a few months prior when it was at pennies, it was like 1,000x. Axes did basically 1,000x to its all-time high and has now retraced 80%. This is normal. The question is, where is it going to be 5 to 10 years from now? Because this is a 5x gets lost in the wash. A 5x in most venture capital companies' portfolios are the ones that they don't care about. So we also want to keep making investments because maybe I'm super bullish about Atlas today, and then they start underperforming, start doing poorly. They're not, by the way, but let's say that they were. Then I would decrease my interest in that investment, and hopefully I would be investing in other games I thought was interesting. But largely we're interested in games for a few reasons. So I'm going to go back to the question sentiment because I know that there are a few other questions here, and I think that they are somewhat related. So, okay, so private Den member questions only. We will now no longer ever look at the YouTube chat. I apologize. If you want to get your conversation in with us, you got to sign up for the paid group because there's too much crap in the chat. I still love all of you who are in the free chat, but it just is easier this way. Okay, so one of our private members, Bruce, says, I was expecting to see a bigger drop in Bitcoin with the Russian invasion. Instead, we saw a small drop and a big rally. What are your thoughts? Great. This brings us back to that core idea that when you see fear or blood in the streets, that is a buy moment. It is unilaterally functional. You can rewind the last 150 years, and if you, more than buy the dip, buy the fear. Buy the moments when the news is telling you about invasions or war or pandemics or asteroids. Buy that. Because understanding a good investment thesis is understanding that when the average person is scared of something, you should be going back and acquiring assets. It makes for a great investor, but you have to put that person in a different place because you have to ignore the war and whatever's happening. Oh, yes, this is an opportunity. This is the opportunity to buy, generally speaking. So a big rally actually, I think, has a little bit to do with our general thesis here, which is that Bitcoin isn't a hedge against inflation. It's a hedge against, as we get further into it, fear and the realization that you probably can't trust your government. Somewhere along the way, all governments have failed. They have done the same things by destroying their currency and then doing crap stuff to their people and then doing crap stuff to other people until there's basically no longer anyone left that anyone trusts, and then it all crumbles to nothingness and it starts over again. And no, Orion Square, your chat here isn't considered crap. It's just we want to make sure our private members get the focus questions instead of people in the group. So I thought that this was an important way to do that, to highlight the private group for the private members so that they get their questions asked. Okay. Drowkin also responded here with an update. He says, I think everyone expected down, so what does the market do? But people don't expect. Also, leverage messes with it. Cool. Yes, I agree. Well, leverage doesn't mess with it. It just adds to more volatility. I hear you. Maybe the Russians are moving their money into Bitcoin. Again, I think that if we go back to what really sold me on Bitcoin, the first run up to $1,000 is actually the Cyprus collapse when the banks started freezing money. So what Canada is doing, this is what Bitcoin is designed for. Governments cannot stop it. You can't sanction it. You can sanction the on and off ramps, but you can't with the technology. And that is valuable. Now, I don't know if people recognize how valuable that is, but your ability to freely transact in a peer-to-peer marketplace is worth a lot of fucking money. I tell you that much. It's worth more money than you probably would manage to wager a bet for. And that, I think, is one of its core values. Its core value is that if you and I want to make a trade for one asset to another, and either of us want to buy or sell that Bitcoin for that asset, we got a deal, baby. And the governments cannot stop a peer-to-peer transaction. They can't. They can go a long way out of their way to try to stop, again, the on and off ramps. But if you end up in a place where you can make that trade, you've just had a peer-to-peer agreement. And that's what this technology does. It supersedes the need for a money that we agree on to be designed by a fucking government who's have always failed. All of them. All of the governments have failed at some point or another. Almost all the constitutions have and freedoms of humans have been trampled on at one point or another. And the humans then always stand up. And then at one point or another, they overthrow those tyrannical people. At one point or another. It's happened a bunch, guys. Like, we shouldn't be surprised by it. You should invest on that thesis. Okay, so what did that bring me to? Oh, yes. Why I think Bitcoin's valuable. That's the pretty crisis when they first started locking up bank accounts, when they first start trying to put sanctions on money, even if you happen to be just a regular person. That's what really makes this technology shine, because it works. Think about it right now. This actually can lead us back into our video game thesis. We have ample evidence now that RuneScape in Venezuela is actually a widely accepted currency. It's a video game currency that's not on the blockchain in any way, shape, or form, and it's actually better at holding value than the Venezuelan bolivar. We see the same thing happening in the Philippines. The smooth love potion is now the accepted currency of that geographical area, because people trust the game more than they do their government. These assets outside of the government's purview are not designed to be inflationary hedges. They're designed to be assets that we can use as money between one another that's not controlled by the government. Now, everyone thinks it's like, well, only criminals would do that. No, not just criminals. As governments decay, they start to aim their guns at everybody. Do your homework, ladies and gentlemen. The Bolshevik Revolution, or the Stalin, they started aiming their guns at everybody. It's not again, so yeah, homework is a great part of the thesis, and it helps you build patience too. So brings us to the next few questions. Can we get a Solana update on the megaphone that Glasswalker pointed out? Okay, so we'll take a look at Solana. What would you invest in? Well, market is bearish. BTC, large arts, mid alts, low alts. Okay, this is kind of a fun question we can spin together. Sander is asking, what can you invest in while the market is bearish? And then can we get a Solana update? Okay, so what we should invest in when the market is bearish. Every investment comes with risk. The newer the asset, the higher the risk. It's a pretty clear stepping stone. Venture capital is like the newest onset of ideas. This is why we always suggest reading books that kind of move around this thesis. The longer an asset's been around, like in Amazon, the less volatile it becomes, even though it's still a great investment. It will carry on. I mean, you can also put larger sums of money in it. The more volatile the asset, the smaller the sum of money we need in it for it to potentially pay off in spades. Doge was one of these ones where like, hey, you could have $1,000 there, and that's not a bad investment. Why? Because people like memes, and people like meme money because that's what fucking money is. That's like what we talk about always. Money is a meme. All of money in currency is a fucking meme. It's not, there's no intrinsic value to the US dollar. It's a meme. So what do you invest in? Well, again, maybe let's say the higher the meme or the lower the community that meme exists in, the more volatile the price of that meme will be. This is fun. Okay. So Solana, we think is a very powerful technology. It's also a very volatile technology. Now, one of the rising megaphone questions we can look at here on the 6 hour. We'll get rid of some of the noise here on our chart, and let's look at the Livermore megaphone that brought us to this crazy explosion. Because if you can spot them, especially when they're on the smaller time frames, they're so valuable. Okay, this green Livermore pattern over here, this was super powerful. This was a moment to say, throw fucking every penny you have at Solana. We saw that with Ethereum too, although it was an older asset, so we can then also infer the volatility is likely lower. And we want volatility. We want a fuck ton of it to the upside. We want as much volatility to the upside as possible. Want to go to the moon and beyond. So when we saw this first megaphone pattern and these secondary reaccumulation patterns, we knew that we were going to get more upside. We just didn't know how much. Okay, well, here we go. We've actually gone into downside. Are we in a bear market? Could we come lower? Hell yeah. Solana was down at $3, but its main support is back down here at 39. So let's say we want to make an investment in Solana. It's a mid to new technology. It has not been around for that long. So more than the price of its market cap, I would look at the time that it's been around. The less time it's been around, the less likely that it's going to continue to be around. This is known as the Linley effect. So if we know that how long an asset's been around is likely how much longer that asset may be around. Like for instance, a four-legged chair has been around for a long fucking time. Like owning the patents on 4 legs on a chair would have paid off basically fucking forever. Whereas DVD, not so much. Compact discs, not so much. Laser technology, well, if you invested in the technology that edits eyes, yes. But in discs, no. So lasers at large, yes. But for specific technology, no, again. So if we're trying to understand how technology moves, is adopted, and then discarded, we don't know, right? So both Solana and Avalanche are new, and they represent, in my thesis, a mid-range of the venture capital sector. The more highly volatile aspects of venture capital come into our play to earn thesis. And again, we started to really narrow that down. We've looked at things like Woo and Rook and a bunch of the other DeFi sectors. We're really going to hone into play to earn basically only. Look how wildly volatile Woo has been basically. It's under this enormous explosion. What it was Woo from point of control to high? 6,000%, a clean 60x in 290 days. See, this is the crazy thing. This is what venture capital looks like in such a short order. If getting a 60x in 290 days is amazing. Like even if you only had $1,000 in Woo in January 29th of 2021, at its high, you were sitting on $61,000 from a single $1,000 investment. And today, still sitting on a clear 14 grand from $1,000 investment. This is asymmetric upside in a very short period of time. Now, again, we always look at price and think I missed out. You didn't. There's so much time here. You could have thought you missed out on Apple, not making the first venture investment into it in the 1970s or something. Here we are, equally as awesome opportunities. Just have to find stuff super early that people think you're a maniac for investing in. I love the new video game thesis. We've been playing Fortnite. I'm going to download Stardew Valley tonight. Getting really into it. Anyways, last few questions from the private group. Will there ever be an Arcane Bear ETF? Nope. No, will never be on the public markets. Private companies, could you maybe invest in something we're working in? Maybe in the future we will open a venture fund, but we like private company movement. It's just easier to deal with. Green light in the background, yes. Bullish for sure. I agree. DNA confirmed for the last question of the day says, I think the war has caused an increased focus on assets and how people can protect them. Great point. I agree. The necessity has been greater due to the state of the world, economy, and inflation. Mainstream adoption of Bitcoin with its unique selling proposition will increase faster than mobile phone and internet adoption. We are witnessing mainstream birth and realization of the value of Bitcoin. The cost of energy is going up too, and Bitcoin's energy is so much more. So, this brings us back to our core thesis. Bitcoin isn't a hedge of inflation. If you watch the first video I did, or I guess it's the second on Arcane Bear, I talk about why Bitcoin's going to go to $2 million. I said $6 million at that time. Let's see if I'm right. So I said in 2017, the second YouTube video I ever made, I said Bitcoin was going to $6 million. So we'll see if I'm right. But the point here is that when I made that video, although I included it as an inflation, again, as a beneficiary, like Bitcoin's price is up because of inflation. It's not a hedge against inflation. It's a hedge against the governments who are causing the inflation. It's a hedge against the governments who cause a total loss of confidence and faith when they do things like attack. So for instance, they're putting all these monetary sanctions on China or on Russia. Well, what if you're a Russian citizen? You have nothing to do with this. Can you touch your assets? Well, maybe not. What about when the Canadian banks freeze your assets? These are failing governments that are increasing the likelihood that these technologies will be adopted, is because it is them who we do not trust. It is the technology who we now trust more than the governments, because people are starting to remember that governments always at one point grow too big and basically fuck everyone over. Anyways, deal with the arcane bear. Thank you for joining us today. Had a lot of fun. An hour long almost. I figured we should do it just because we hadn't made a video all week. So thank you for those who joined for the entire time. I appreciate you. Yeah, we'll do it like this from now on. Private member questions only. And we'll do it at the end of the episode. We'll do it once a week, I guess, because sometimes the videos will be just shorter. But we'll try to do the questions from the private community once a week. I appreciate all of you. Oh, yes, and my COO would be remiss if I didn't do this well. Remember, the disease and the sickness of the new investor comes from over-emotional trading and lack of education. So why not join a private group where you're surrounded by people who are going through that day-to-day process, like hitting the gym and making those investments and earning those gains. But go to arcanebear.com/private, where there's no risk for you. So I don't know why you wouldn't sign up, because if you're not happy, we'll just give you a refund because we don't need your money. We just want it there as like a buffer to get rid of the people who don't actually like doing the work. It's like going to a private. So many times, if someone gives you some shit for free, you ain't even going to listen to it anyways. Like, it just actually helps you be more successful. Boom. We'll see you guys in the next episode. Bam.